I'm Blane Odom with Next Chapter Realty Group, and today we are diving into mortgages. We're going to look at how to make mortgages easier to understand, help buyers avoid costly mistakes, and give viewers clear, realistic next steps when it comes to their home buying journey. Today I'm sitting with William Branch from CrossCountry Mortgage out of Rockwall, Texas, and he's going to share everything he knows about mortgage. William, how are you today?
I'm good, Blaine. How you doing? Thanks for having me.
I'm doing good. Will you give me some background on how you got in the mortgage industry and everything about William Branch CrossCountry? Tell me about CrossCountry and yourself.
Yeah, so, kind of a funny story. I started out, graduated college back in 2007. I played golf during high school. Didn't play in college. Ended up playing a little bit outside of school when I graduated. I grew up having dreams of being a professional golfer. I realized that I was good, but I wasn't good enough. I was never going to make it. And I was bartending, and my mom's been in real estate since 1995, and I was going to go be a realtor. And she's like, you're going to be a great realtor, but you're going to have to build your own business. I don't have enough business to give you. She's like, you love numbers. Why don't you try lending? So I was like, I don't know anything about it. So as I'm bartending, I'm like, what? That's great. I have a friend, I know a customer that works at Prime Lending. I'm going to go down there and meet with him. I met with him, came home. I was like, Mom, I'm going to be a loan officer working in a call center. Didn't know anything about it. And she's like, well, that's great. Well, I won't use you for 2 years. So it's kind of a funny story that my brother was graduating at the time, and we had one of my old business partners used to call my mom, come see her, and she said, hey, the guy that owns our company has a position as a loan officer assistant. And so I give my credit to that guy. It was actually Craig Strank at Willow Bend Mortgage where I got started. He taught me 2 years. It was a 2-year role. About 18 months in, I was ready to hit the ground running. I ended up fulfilling my 2 years and then worked there for a year, and then I ended up changing a couple companies since then. Industry's changed a bunch since I got started in 2011. So, but that's how I got started was, learning as a loan officer assistant. And that's where it really paid dividends because I was actually able to see a bunch of files. And once I started, I understood why my mom wasn't going to use me right off the bat.
Because there's a lot to take in, isn't there?
Yeah. I mean, just the guidelines that we have to memorize and understanding which program goes with what buyer and how to work things, different credit scores, different down payments, different situations. And I was able to see that because Craig did a lot of volume back then. And, I have to give credit to him. And then my second business partner, she got me started. She was doing this coaching program. She's like, hey, I've doubled my business in about 4 months. I'm like, well, what are you doing? She's like, well, I'm doing this coaching program called The Core. You need to come check it out. At the time, it was $400. And I was like, well, I don't have $400. I was like, we're working at 2 different companies. She's like, look, I just need an accountability partner. And, I do give her credit for also teaching me the business. She's taught me a lot. And in 2020, we ended up separating, and that's when I started my own branch. And it's been a phenomenal journey up until this point of just learning the business, growing the business, helping families. When I first started, it was about money. And now it's about helping family, helping situations, figuring out problems that are going to rise before they even happen versus waiting until you're knees deep in a contract and it's like, oh my gosh, we have a problem.
And now you have the experience over the last 15 years where you've seen it all, you've done it all, you know it all. Yeah, that's a good place to be.
And
good
so
partner to have.
Building a team, it's not just all about me. It's having good team members and good support, not only just that work with me, my 2 team partners, but also having a good support with a company to be able to help you close loans, not have guidelines, not have different overlays.
CrossCountry Mortgage is one of the bigger lenders in the United States, right?
They're actually the number 1 lender for like the last 2 or 3 years running in the country.
Okay.
I was a little hesitant at first going to a big company like CrossCountry Mortgage, but the amount of programs that we have, it's like there's not a loan that we really can't do. And so, whereas before at the smaller companies I had, like we were limited on what we could do, and that was a little bit of a struggle sometimes. It's like, how do you work for a place that you can pretty much do any type of loan that's out there in the marketplace?
And that's the interesting thing about mortgages for me is like there's commercial, there's residential, there's multifamily, there's farm and ranch, there's all sorts of different purchases purchasers, and then there's all sorts of different clients and incomes and proof of how you're going to pay these things. And so it's really fascinating that y'all can take anybody's circumstance or situation and then be able to help them live out their dreams or help them live out their next business venture.
Yeah. I mean, and it's the mortgage business has definitely changed over the last several years with the different types of loans, as you mentioned. You know, before you take your self-employed borrower that would go to a bank or come to somebody like us and we're like, hey, give us 2 years tax returns. You need to show income on tax returns. Well, now we have so many options for self-employed borrowers now that we're getting people approved that would go to a bank and get turned down.
That's great.
Just by using bank statements or 1099s or a profit and loss.
That's great. I've been through that process with like home equity lines of credits, and it's like, oh, they want every single piece of information possible, and they do all of this work for 3 and 4 weeks, and at the very end they're like, nah, like you haven't been in business long enough. Well, I told you from day one, like what my situation was, and you could have told me that from day one, but you didn't do that. Where if I went directly to a lender instead of some big bank, maybe I could avoid that whole hassle. Right.
And it's been able to help us think outside the box. You know, I like those options for your self-employed borrowers because, okay, the bank or lender tells you, hey, you need to claim $200,000 in taxes on 2 years worth of tax returns. Well, guess what? Now Uncle Sam's going to get 25-30% of each year.
Yeah.
Or be able to invest back into your business, buy equipment, buy whatever, reduce your tax liability, and you're able to get a mortgage by just using your bank statements to buy a house.
Yeah. Well, you got to be creative with some of that. You got to have experience with that. You got to have access to those types of loan programs where the more I talk to you about people's unique circumstances, the more my eyes open to where there's a will, there's a way. Right.
And I think that's one thing that kind of separates me from, others is that always trying to think outside the box and finding that solution versus just telling somebody no.
Well, you just answered my question. What is something about your job that most people would never expect?
Well, it's funny that, that was the case, but every situation with somebody is going to be different. There's not two borrowers that are exactly alike. And so finding loopholes, looking through when somebody tells somebody no, it's like, how do you figure out to tell somebody, yes, you can buy a house?
Yeah. Okay, so I've got a lighter moment for you. Be honest, how often does somebody apologize for their credit before you have even looked at it?
I have a lot of conversations every month with clients, and that's one of the first questions I ask is, hey, any idea, before we even start the credit pull or soft pull, is how is your credit? Mm-hmm. Some are honest, hey, I got an 800, I got the best credit score in the world. Nobody's got a higher credit score. It's funny when I have a husband and wife and they compete with each other. It's like, oh my gosh, my husband has a better score. I'm so happy I get to tout that I got a better score than my husband. So that's always fun. And then you have the clients that are like, they either don't know, they'll say that they don't have credit, or, hey, I have a lot of stuff that's on the credit that's, some charge-offs from way back when or whatever it may be. So it's a variety. And the ones that may not be able to buy now, we have solutions for you and options to be able to put you into a program with one of our credit repair specialists and help them create that plan to where they can buy versus just saying, hey, nope, on to the next.
And that's kind of one of the biggest things I always talk to my customers about is like, there's a way forward. Like you might feel stuck and you might feel like there's no way you can achieve what you're looking to achieve, but you got to start it with conversation. And so you got to come in, be honest, drop all the information that, is being asked of you. And more often than not, there is a way forward. And sometimes that answer's like not, immediately yes. It's yes if you go do A, B, or C, like this credit repair program. So,
and sometimes you don't need credit repair. We have software that tells people. I was working with a client this past week that their credit score was currently at let's just call it 670, and I said, hey, if we can pay these two accounts down to X dollars, it's bumped them to a 740 plus credit score, and so now we're saving him money on interest rates, so saving him money in a monthly, but also saving him a bunch of interest over the term of the loan and getting him a lower rate and a lower payment up front.
Okay. Well, I kind of wanted to structure this whole conversation around past, present, and future.
Sure.
And so the past being a few years ago, we kind of got spoiled in home ownership and lending with a 3% or sub 3% rate. So those days are long gone, right? We're not going to have any of those 3% rates anytime soon. If people are thinking about being on the sidelines or they're waiting for the perfect interest rate, is that going to happen?
It's interest rates have been in the mid fives to all the way up to 7.5. So we've been in this realm since 2022. So for the last 4.5 years, interest rates are where they are. They talked about
what drives interest rates. Explain how interest rates come to be in the mortgage industry.
Well, there's a lot of things that drive it. You got inflation, you got job numbers, you got CPI, you got PPI. So all of those.
But is there like one bank that does that? Like, isn't it controlled by the Fed?
So
loosely.
So it's not necessarily a direct correlation. So like when you see the Feds dropping their interest rates, well, a lot of times what we see is that the mortgage rates have already fallen weeks prior to that Fed drop because they've already expected it.
Okay.
And so, I get the question every time, hey, the Feds dropped the rates, did mortgage rates drop? Well, the last 5 or 6 times they've actually gone up. So, but we've already seen that.
Because they over-anticipated.
Well, they've already built it in.
Yeah.
And so, but whenever the Fed comes out and speaks, they've already done their analysis.
Okay. So if I'm getting a loan from you, where does the money come from?
Well, we service all of our loans, or majority of our loans, but everything comes off of a warehouse line, and then you can either sell it to us. The mortgage company will sell it to a servicer, or they'll retain servicing.
Okay.
So I love that we retain all of our servicing because we have control of that. We'll be able to monitor rates and so forth, so that a lot of the the servicers, they do a lot of bait and switch. Hey, go get this. We have this 4.99 or 5.99 rate now. Well, what's the cost?
Yeah.
So whenever you're looking at that one, definitely people are trying to save money and refinance. They quote this, low rate, but there's also a cost with that too. So
they're front loading a bunch of closing expenses,
correct,
to buy you into that lower rate.
Right. And so you have this lower payment.
Yeah.
But what did it cost? What's your break even?
Yeah.
And that's when you're looking at that number, and most people don't think to look at that. They're just slowly looking on what is the monthly payment.
You got to see the full picture, and I see that sometimes with my clients. They looking at the top line number, like my offer was $500,000. Well, you didn't see that they're asking for $50,000 in concessions, or their agent wants a 4% contribution to their commission, and so what. I guess the biggest piece of advice to consumers, whether they're selling a house or getting a mortgage, is like, what is that net expense going to be on the front end to process it and the total rate, right?
Right.
Okay.
Well, that's a great point that you had there. It's like when we're talking about those closing costs, right now it's getting creative to get sellers to move because, I like the analogy, buyers still think it's 2008 and sellers still think it's 2021 where we have multiple offers. Where these closing costs, it's more beneficial to get your closing costs paid and buy down the interest rates than it is to lower the price of the house.
I got you. Is most of your loans they're 30-year mortgages for people buying homes? Is that primarily like a bulk of your business?
I would say majorities. A lot is 30-year money. We are doing some ARMs, adjustable rate mortgages. We all are projecting that rates are going to come down, so having to be able to get a lower interest rate on an ARM may be more beneficial because we're going to be refinancing that mortgage in the next 5 to 7 years.
Tell me about, there's been rumors about a 50-year loan. That's kind of a scary thing, maybe? What do you know about that?
I haven't seen the 50. I've seen the 40.
Okay.
When you really do the math, what scares me is the interest.
Okay.
And is there really a monthly savings? I mean, for some, $100 a month may seem like a lot, but that interest on that is a ton. It's like all your money's going to interest, and none of it's going to principal.
Because of the way it amortizes early on, right?
Yeah, because all your interest is front loaded on the front end.
Okay. Well, we had spoke briefly yesterday about the word mortgage and where does it come from. So tell them what you learned or what we came to uncover about the word mortgage.
Well, it was funny, looking at it when I read it. It was talking about death, and I'm like, okay, well, are we going to be in debt for life?
Yeah.
But also too, it's like debt is a good and bad thing. If you structure it properly, it can be a great tool. As far as you being able to afford it and continue to make payments. If you don't make payments, well, that's where the death comes in. And they're going to take your house from you.
Sure.
The other part that I read was that the death comes whenever you pay the mortgage off.
Mm-hmm.
So I think having debt is a good thing. It's a great tool, especially in the mortgage space. There are things like car payments and stuff like that, credit card payments. That's not good debt.
Yep.
I made the mistake back in 2018. I had a great investment that I won on, and we went and paid cash for a car, thinking, oh, let's have no car payments. How cool would that to not have a $1,000 car payment, $800 car payment at the time? And 3 years later, we sold that car. Bought the car. Just call it $80,000. The car they gave me $30,000 3 years later. So that was not a good investment. Where if we had to put that money in the market, time value of money, that same $80,000 continue to make the normal payments would probably worth double that in 5 to 7 years.
Sure.
And so that's where whenever I look at somebody that's paying cash, I always ask the question, why? What's your motivation? I talked to a lady. I'm actually meeting her today. Wanted to pull $700,000 out of a 401k. And she's going to have to pay about $160,000 roughly in taxes. So that's $860,000 out of her 401k that she has. And that's not a smart move. Whereas if we pull a portion of it for the down payment, right? She's got a house she's going to sell. We're going to look at what's called a recast on her house. So I'm going to look at options to her to show her how can we leverage this, not have to pay taxes on Uncle Sam, but also be able to keep her money, that her advisor is going to be able to take that $600,000-$700,000 and grow it to another 1.4 in the next 7 years, and the rule of 72.
And that's the other fascinating thing to me about the whole real estate industry is, like, I can't be everything for everybody. You can't be everything for everybody. You sometimes have to bring in your tax professional to talk to potentially a lender, and this is to come up with the right strategy for all of these pieces to come together and work out to the best ends to means. I don't know how I'm trying to explain it, but basically there's a bunch of different people you have to bring together, and I try to, obviously as a realtor, I'm trying to quarterback that with all the different parties, but a lot of times when people are trying to make some of these bigger financial decisions, they do, especially seniors, they got a ton of equity in their homes, and it's like, how can we effectively deploy that equity or recapture some of that equity while minimizing our taxes? And that's a super, super important thing. But I don't have those answers. You don't have those answers. And the tax guy doesn't, like the accountant doesn't have all those answers individually.
Right.
Sometimes we have to collaborate on what the best strategy is going to be for those clients to achieve their goals, right?
Exactly. And it was funny when I told her that, she's like, it's funny you say that. My advisor said the same thing that you're saying.
Yeah.
So
well, that's
great. It was great validation for her to trust in how I'm setting it up, because when I set up a mortgage, I set it up just how I would set it up for myself or somebody, even my mom or even my own kids.
Sure.
And so that's how I look at things, is like, what's the best financial picture for somebody? And it's not always putting the money down. Sometimes we have clients that have credit card debts or car payments or selling a house, and it's like, question I'll ask them, it's, if we take that same amount of money and I can eliminate, we'll use $20,000 for example, that'll save them, they have $800 to $1,000 in payments. Well, $20,000 is only going to save somebody about $140 to $150 a month in a payment. But if we can eliminate that debt, I just now eliminated $800 to $1,000 in monthly cash flow for them, plus the interest that credit card payments take at 28 to 30% interest. So,
well, that some of those things sound too good to be true, and I'm always a big trust but verify kind of thing. I can tell you this all day long. Go verify it with the lender, and then after you've spoken to your lender, go verify it with your tax accountant, because they're going to be the ones that put the pen to paper and go submit that to Uncle Sam and make sure the strategy's working, right? All right, let's dig into first-time home buyers. There's some rumors out there that as a first-time home buyer, you've got to have 20% down to put on your house. Is that true? What's the minimum you can put down on your house? And I know the answer to this, so explain what PMI is as well.
Okay, I'll start with your first question. So one of the biggest myths I think that's out there is that people have to have 20%, they have to have 10%, they have to have 5%. So yes, those are all great options, but you technically don't. There's phenomenal programs. They used to be for first-time home buyers. They're now open to anybody that qualifies. We have down payment assistance programs. We help people buy houses with less than $1,000 out of pocket. And
That's awesome.
That includes inspection.
That's awesome.
I mean, it's so cool to get to work with somebody like that.
When you say that, I just think home ownership is available to anybody.
It is. If you can make it work, yes,
Yep.
absolutely.
All right, I didn't mean to interrupt you.
And
Keep
so,
going.
you take that renter that is paying, that's going to go rent a house. That's going to, let's just use $2,500 a month. So it's going to cost them $5,000 to get into that home, right?
Mm-hmm.
They're still looking at your debt to income. They're looking at your credit. Whereas you utilize one of these options, we can help you, and I can help them get into that home. We use the down payment assistance. We negotiate the contract with some seller paid closing costs, and that's how we help somebody buy a house with less than $1,000 out of pocket, or first year's insurance premium, whatever it may be.
That's awesome. That's awesome.
The second question you asked was about PMI.
Yep.
So typically you'd need PMI whenever you don't put 20% down. I think PMI is a good thing. That, again, save that money.
PMI is private mortgage insurance?
Private mortgage insurance.
Okay.
And so you have private mortgage on your conventional side, and then on FHA has what's called MIP.
Okay.
So it's called a mortgage insurance premium.
Mm-hmm.
And so theirs is constant.
Mm-hmm.
Whereas on the conventional side, it's going to vary depending on your down payment, your
Mm-hmm.
credit score, and loan to value.
Good deal. Is there a way to maybe pre-calculate, if I'm not putting 20% down, what my PMI or MIP would be for every $100,000? Is it like $100 or $200?
It's going to vary. It's a percentage base. So there's mortgage insurance companies out there that they have tools that will help you calculate. You can actually go in and load what your credit score is, what your down payment is, how many borrowers are on the loan, debt to income, and then it'll spit that out. There are options to where you can reduce that monthly PMI, where you can actually do what's called a split premium or something like that, where you pay a portion up front and it'll reduce that.
Okay, good deal. My next question is, can someone qualify while carrying student loans? I hear the rumor, it's like, oh, I've got way too many student loans. I need to just like rent until I pay those off. So what's the deal with that?
Yeah, so there's several different things that we're looking at there. People that are in school or have their loans that are in deferment.
Mm-hmm.
So depending on the loan program, it's typically a 0.5% to 1% of the total loan balance. When those student loans go into payments, then we go off of what's on the credit report for the payments. Sometimes we can also talk to a client to go to the student loan company to see if we can get income-based payment options, and that will lower their student loan payments.
That's
to
great.
help qualify.
Well, as we talk about students, and my sister's in this particular situation, she just graduated. She's going to be a nurse practitioner, so she's going to have hopefully a high income type of job, but she doesn't have a lot of employment history. And so what do you do for people that have limited employment history and they're just coming out of school?
Yeah, so typical rule of thumb is that you need 2-year work history, right? And that's kind of a myth. So somebody like your sister, in her case, she is gone to school for 4 years or 5 years, however long she went. We can actually use that as her job history, even though she made no money in college.
Okay.
And she's going into the same field that she was going into.
Okay. Well, that's great. So the flip side of that, if somebody has a high income, does that automatically mean they're going to qualify for a loan?
Well, sometimes it depends. A lot of high income earners typically have higher debt sometimes.
Sure.
They drive nicer cars. And so that can play a factor into somebody's qualifications.
Debt to income ratio.
And that's
Yep.
where we're looking at that debt to income. And each loan program is going to have different characteristics on how high you can take your debt to income.
Sure. So my affordability question for you now is, when someone asks how much house can I afford, is that really the right question, or should they be asking what payment fits comfortably into their life?
It's a little bit of both.
Mm-hmm.
Taxes and insurance have definitely, done a number on mortgages over the last couple of years. I don't know about your insurance, but mine's basically doubled or tripled since I bought my house. And,
Absolutely.
home values have also gone up too, so that's making taxes higher. But one of the main questions that I ask is, what are you comfortable with? What is your budget? And they'll come to me and say, hey, I want a payment of $3,000, but I really want a $450,000 house.
Mm-hmm.
So in order to marry the two, you're going to have to pay more money down to get to that $3,000 level. Or, hey, can we move some things? Can we pay off some other dets to help get you that number to where your cash flow's the same.
Mm-hmm.
Or, hey, is there any way that we can take that $3,000 budget and kind of expand a little? Maybe we go to $3,500 a month. One of my mentors always said, hey, buy a house 3 to 3.5 times of what you make in annual income.
Okay, so if somebody's making $100,000 a year, or household income of $100,000 a year, then kind of that general consensus would be $300,000 to $350,000 would be their target purchase price, right?
Correct.
Okay. Was that advice said when the interest rates were at 3% versus 6%?
Well, this was definitely, back in 2015.
Sure.
When he told me this, and
Sure.
so I always did the math, and it's held true.
Sure.
With that number, so that's about 35% of what somebody makes.
Sure. Okay. I'm trying to think back to my first house. I think my first house cost right at $108,000, and that was on a $40,000 salary. So it was kind of good in that range right there. Okay.
So let's talk about that. Let's
Sure.
talk about you buying your first house.
Sure.
What's it worth today?
I looked at that house not too long ago. It's worth $195,000.
And you bought it for how much?
$108,000.
Okay. And how long ago did you buy it?
That was back in 2009.
Okay.
So we're right at 16, 17 years ago.
Okay.
I'll tell you a quick story about that experience. Everybody I was talking to, I would get my loan number, and it was always my principal and interest. And I was like, I can afford this. This is no big deal. It was like $580, $600. Like, yeah, like this homeownership's great. And then I got that first loan statement, and I think the rules have changed to fix this, but nobody really explained the escrow piece about taxes and insurance.
Yeah.
And so when that first loan hit, or that first payment came in the mail, and it was like $960, and my payment jumped by 50%, it was like the most devastating, terrifying, what have I done moment. And I had to grind through that budget adjustment on a monthly basis, and it was an awesome thing in the very end, but it was uncomfortable up front. So my advice to people now versus when I bought my first home that 16, 17 years ago is make sure you understand the PITI, right? Which is principal, interest, property taxes, and homeowners insurance.
Yeah, so I'll hit on that real quick. So obviously taxes and insurance can change yearly, and so it's important that you really pay attention to your escrow analysis when that comes out, because they're going to
escrow is where they hold
the taxes
the
and
funds,
insurance.
to pay on the annual basis.
And so if there's not enough funds in that escrow account because they had to pay a higher tax or higher insurance the year before, if you keep it the same for the next year, you're going to have even bigger shortage. And so that's when you see people's payments really go up, because they didn't either adjust for it, or they didn't pay the amount. There are options where you can go to your escrow account, escrow servicer, and say, hey, can we spread this out over like 24 months to make it a little bit more affordable. But it's really important for people to pay attention to those escrow accounts.
Sure. And I've had horror stories of customers that their lender dropped the ball on the escrow account.
Yeah.
And those property taxes and insurance payments accrued over 2 years, and now their payments increased by like $1,500 a month, and they were forced into like having to let the home go because they weren't fully aware that that situation was going on in the background.
Well, and I see that a lot with some builders, that they will, because when you build a house, typically the house is only assessed at basically the land value. So if you don't anticipate what the projected estimated taxes are going to be, you're going to be short.
Yep.
And that's how those clients fell into that downfall, is because of that situation. And it's like, hey, let's get you in the home, and then I'm sure the lender or the escrow officer told them, hey, make sure you save X amount of dollars because you're going to have to pay. I always set it up front to where I'd rather front load it and have you overfund that escrow account that first year on a new build than try to let somebody have that lower payment up front, because things happen in life and next year comes around and you don't have the money to pay it.
More or less, though, one can bank on here in Texas that their note every single month is going to change next year because of the projections of changes in taxes or homeowners and insurance. If your escrow account is adjusting, then your monthly payment will adjust year by year too, right?
Typically, yes.
Yeah.
And that's
Okay.
where it's always important to either hire a company to fight your taxes,
Yeah.
shop your insurance every year,
Yeah.
or you go and you fight your taxes. You can work with your real estate agent. They'll provide you
Sure.
a market analysis on your house, and you go down to the county. I've done it every year.
Sure.
And, be able to fight them.
There's
And that's an interesting topic,
Yeah.
too. If you ever go do that, the way that they do their
you fight your
adjustments-
taxes every year?
I do.
Yeah.
Yeah.
Well,
I
they
used to
blanket
hire-
increase, right?
I used to hire a company,
Mhm.
and now I do it myself.
Mhm.
Being in
Proven
the industry.
effective?
I've been effective. Last year I was able to just maintain.
Yeah.
This year I was actually able to drop them by 100,000.
Oh, great.
So,
Congratulations.
I don't really feel it in my payment, but hey, I feel like that was a win for me.
It's no easy feat. It's one of those things that I think people have become more aware of that because of how home values accelerated through COVID, after COVID, and now things have slowed down a little bit.
Yeah.
And so just a good example, I've got a client, she has some land. The land's valued at $1 million on the tax roll, and we've had it for sale for $700,000 for 6-8 months, and it still hasn't sold. Well, you can't tell me that land's worth $1 million when we're at a market price of 700. So
Did she go fight it?
We use the listing as evidence to support that the property was not worth that valuation, and so they dropped it to asking price, and she's going to save $5,000, $6,000, $8,000 depending on
That's awesome.
when we get it sold, right?
That's awesome.
So super important thing, and I see that even in my neighborhood where there's 4 or 5 different models of our home, and more or less everybody's got the same house,
Yeah.
right? They all have their own unique characteristics, and some have been updated and some haven't been updated, but I've seen $100,000 spreads between my home and somebody else's home with very similar updates, right? And it's like, how is that fair to those people that they're paying $100,000 more in appraised tax value when essentially we have the same thing?
Yeah.
And it's like they never even fight it. you know?
Well, on the comp piece, when you go to fight your taxes at the county, it's so funny how they do their adjustments. It's not based on sales that's in your neighborhood.
Mhm.
Like some of the adjustments that I kind of chuckled at. I mean, he was saying that my interior finish out it was almost like $400,000 difference in adjustments on interior finish. I'm like, how do you know? Like, you've never
Yeah.
even been in my house.
Yeah.
Like, there's no pictures of. I've updated and we've done some things, but
Yeah.
it's not $400,000 worth.
Yeah.
So
Well, the other fun thing about all of that is you can go fight, you can not fight, whatever, but my understanding is they settle all of the appraisal disputes and then they set the tax rate afterwards so they can hit their budget no matter what.
Yeah.
So if everybody fights and reduces it, everybody's just going to have a higher tax rate. If nobody fights, then maybe they can reduce the tax rate. And so it's
Yeah.
one of these things where the system, I'm not calling it rigged, but the system is designed to make you feel good about yours individually, but at the end of the day, the county still needs their resources, support the school, support the fire department, support the police department, all these things. So,
let's talk. You mentioned something about people that have low interest rates from back during COVID.
yeah.
Let's talk about that. For a
Okay.
minute.
So one of the things that always comes up for me is people that maybe bought those homes during COVID. I'm always asking, is that rate assumable? Because if they're looking to sell that property, they can't just pick up their mortgage and carry it with them. Typically, not even typically, always the mortgage stays with the home, right? And so it's one of those things where if somebody has an assumable loan, that is a perk for us to be able to sell that home and maybe get a premium because people can buy into
Yeah.
a lower mortgage rate. Do you have anything to share about that?
Well, do you know how the assumable mortgage process works?
No, you can explain it,
All
please.
So, that's a great selling point for people. Obviously homes have gone up. They've basically, a lot of them went up 50%. Some of them went up 100% during COVID, right?
Mm-hmm.
And so let's just say that you got a borrower that's got a loan amount at $200,000 with a 2% rate. You're trying to sell this house for now $400,000. Well, now this buyer has to make up that deficit or that delta of $200,000. So they got to bring $200,000 to closing, and then they get to take on the balance of what that seller has. So they got to make up that whole delta from what the borrower owes from what you're selling it to be able to have that.
I understand.
So it can make it a little bit more challenging. I do know the process of somebody that can do it. It's they say it's not really a fun process because I think that the servicers, I don't know if they like them or not like them.
They make it difficult on purpose, right?
They do make it difficult
because there's
on
more
purpose.
money.
Yeah.
Even if it goes to the open market, like there's more money for all lenders if that changes, right?
So, the assumable option's a great option for people that, have the ability to do that. Take on a low interest rate mortgage. That's a phenomenal tool to be able to have access to. And you can do that on FHA and VA. But what I wanted to talk about was somebody that's got a low rate that's looking to move. They likely have a lot of equity in their home, that they can use that equity to still buy another house, have somebody be able to pay their mortgage, they can even pay the equity of what they're taking out.
Okay.
And so now they can keep their house at the 2% that they're not wanting to give up,
okay,
and go buy their forever home, and somebody's paying all the payments that they've taken out plus all the equity that they've extracted from their home.
Okay. So in a situation like that, what happens to their house they're moving out of?
They get to keep it. They're going to rent it.
Oh,
they're going to turn it into an
so they become an investor, right?
They become an investor.
Yep.
And, a lot of those people, depending on who they were, they may have put minimal down payments.
Mm-hmm.
And so now they got all their money back that they put down,
mm-hmm,
plus they've got the money to go put it on a new house.
Mm-hmm.
And so we'll do what's called a home equity line of credit for somebody. And I advise you can either use all of it or let's use a small portion of it so that you can save that, because things happen on rentals. When I talk to people, they're like they fear being a landlord, right?
Yep.
Well, being a landlord's not a bad thing. You just got to find the right tenants.
Mm-hmm.
So you got to screen your tenants really well, look for people that have good credit, good jobs, good job history, pay their bills on time, that kind of thing.
And there's management companies that do that for you.
100%.
Sure.
We have a couple rentals, and it's probably been one of the best things. That's what we're using for our kids' colleges, and it's just a great tool. I look at things as far as investing in 4 buckets. I think you need real estate.
Okay.
You need your retirement.
Yep.
You need your other savings accounts,
mm-hmm,
and then your any other extracurricular investments that you want to buy into, like if you want to start buying stocks and stuff like that.
mm-hmm.
But there's 4 buckets that helps you build your wealth.
Okay.
And so I think real estate's one of the best tools because homes appreciate on average, 2 to 5% a year on average,
mm-hmm,
most years?
Yeah,
about
so
2 to 3%.
I think the historical average is right at 4%.
Okay, so you take a $400,000 house now, it's at value of that, you're going to earn $16,000 a year in equity appreciation.
Not guaranteed in 1 year, but over time.
Yeah.
Yep.
And so, some years are higher than others.
Sure.
COVID was kind of one of those years where, it was just stupid. We were going up, 15 to 20% a year.
Yeah.
That's not good. That's what
Yeah.
created the inflation that we were in.
Yep.
That we're in now. But it's one of the ways for you to build wealth and be able to use it as a tool and be able to use that money as tax-free money,
mm-hmm,
versus if you were to sell a home or sell an investment home. Like I have clients that have investment properties, they go to sell it. Well, they're going to now pay capital gains to Uncle Sam.
mm-hmm.
Well, why not just leverage that property and let somebody continue to pay the mortgage,
Yep,
and pull that equity out to go do what they want to do with that money?
Yeah, it is that diversification of assets, like being in stocks versus, being things in things like real estate. It does get very interesting when you start thinking about being a landlord instead of this is just a roof over my head.
Mm-hmm.
It is a vehicle. It's a vehicle where it's fascinating because you buy at this price and somebody can help you pay down that debt while that asset is also appreciating.
Yeah.
And it's like, what other things out there are like that? Like I start thinking of stocks, and it's like, if you buy a dividend stock, maybe that stock isn't on a growth track, it's staying right here and it's paying you a dividend. Well, if you think from the real estate aspect, over time that asset is growing in price and paying you that dividend.
Well, and the reason why I like it the most is because just kind of what you were talking about, it's how much money would it take for you to put with an advisor
mm-hmm,
to make $16,000 a month,
mm-hmm,
a year in interest?
Sure.
It's going to take a lot of money, right?
Yeah.
It's going to take probably $150,000 at 10%.
Yeah.
At a 10% return.
Yep.
If you have that kind of money to do, a lot of people, they may not.
Yeah.
And so that's why I like that as a tool to be able to use it as an asset for yourself. To retirement comes quicker than you know. It's like I'm now 41, and it's like, okay, already starting to kind of think about, what is retirement going to look like in 20 years?
Sure.
How much do I need? And so homes, that same home now, if you held it for 20 years, if it's 400,000, well, what's it going to be worth in 20 years?
Sure.
It's going to be worth 800. It's going to be worth 700. It's going to be worth the same.
Sure.
But historical data is going to tell you that it's going to continue to go up.
Correct.
With inflation.
Correct. Well, kind of makes you think it's a pretty safe investment at that point.
Yeah.
I graduated as we were coming into the economic recession of 2008. I have a degree in finance, and I'm jaded by the stock market, even though a lot of that that economic crash or economic crisis was because of the housing industry. There is something special about having some tangibility to what you've invested in, or being able to show up, or put your hands on that investment instead of it just being numbers on a page or a printout or a screen.
Well, and the market doesn't always go up. It goes. It's if you watch a chart, look at it. You can scale it down, and you can look at any chart. And you pull up a stock and say, hey, let's look at the last 3 months. Hey, this thing's going down. But if you understand the fundamentals of that investment, scale it out to a 2 or 3 year and tell me what that chart looks like. It's not a straight line, but it's almost a straight line going up.
Sure. In
most cases, depending on the business.
Okay. We're going to do a little rapid fire section, okay?
All right.
So let's try to keep it, pretty snappy here. But we're going to do true, false, or it depends. And some of these things we've already covered and you might not need to explain. I'd say maybe go ahead and let's explain the it depends ones.
Okay.
So we're going to start with a question, true, false, or it depends, on the you need 20% down.
False.
Perfect. A mortgage credit pull will destroy your credit.
False.
You should find the house before contacting a lender.
False.
Student loans prevent you from qualifying.
False.
The lender advertising the lowest rate always has the best deal.
False.
A high income guarantees approval.
False.
Once pre-approved, buyers can safely make other large purchases.
True. Well, maybe.
It depends.
It depends.
Okay, so let's read it again. Once pre-approved, buyers can safely make other large purchases. Why does that depend?
Well, that depends because you do not go out and buy anything on credit.
Yeah.
You can use your cash funds to do it. Just make sure you're going to have enough money come closing day to be able to afford the down payment. So before you make those decisions, it's always advised talk to your lender first before you make any of those big financial moves.
I think you told me as advice to my clients, like, don't do anything with your credit once you're pre-approved, because somebody once bought a dog on credit after they were pre-approved and they were getting to closing and they were doing all the final paperwork, and something came up about this finance dog and they ended up not being able to close.
It wasn't a dog. We're barely at the borderline of her qualifying or not qualifying.
Okay.
Right? And this is Friday that we get clear to close. Well, mortgage lenders, we do what's called a soft pull, or we get notifications whenever credit's been pulled during the process. So she went out that Friday night or that Saturday and bought stuff at Rooms to Go. That monthly payment was $150 when we got that bill, got that notification, and it caused her not to qualify. Luckily, we were able to save this deal because she had already paid off some credit card debt that equaled the same amount of payments. So she ended up closing. I've also had clients that gone out and bought new cars in the process, and they didn't just buy one; they bought two, and they bought two new Escalades. These were attorneys. They ended up not qualifying for the house at that time.
I'm an attorney. I'm a high income producer, and it like I'm a high income earner, and I can see how it makes sense. Like, oh, no big deal. I know I can afford it, and then it changes the whole equation. There's a math equation.
So
right?
Just as a rule of thumb, just always wait till you close to do any credit.
All right, we're going to keep going. First time buyer programs are only for low income buyers.
False.
PMI is always wasted money.
I think that's false.
A fixed rate mortgage payment can never change.
The P&I can never change.
The principal and interest.
Principal and interest.
Correct. Fixed rate mortgage principal and interest can never change, but we already reviewed that your taxes and your property insurance can change, so your total mortgage can go up, right? Or down. Paying off every debt before applying is always the best strategy.
False.
You should wait for rates to fall before buying.
I think that's false.
Once the loan is approved, nothing can go wrong before closing.
Nothing can go wrong? that's false.
Absolutely, 100% false. All right, well, thank you for that. That was quick, rapid fire, ton of
fun.
false there. But those are common questions that come up in this process, and it's like people maybe are hesitant to get started, and it's like I don't know where these misconceptions come from, but it's great that we can address those things.
Yeah, and I think the biggest thing, let's just in on that real quick, the biggest thing about that is getting pre-approved. Like, they come to you and they're like, hey, Blane, let's go look at houses today at $400,000. Well, that may not be in their budget.
Mm-hmm.
So they've wasted their time going to show, and you've wasted your time away from family doing other things, looking at the wrong price houses.
Mm-hmm.
And so that's why it's important to understand your budget, what your out-of-pocket expenses are going to look like, so that there's no surprises once you go under contract.
Mm-hmm.
Everybody's different on monthly payments,
Mm-hmm.
but the clients that we talk to that it's, hey, payment is very important. It's important for us that, hey, once we get you pre-approved, like, I'm estimating insurance and I'm estimating taxes. I don't have a property address to go pull HOA and actual taxes.
Mm-hmm.
And so I always tell people when they're in that situation, hey, please send us the addresses that you like, so that we know that, for one, you're going to qualify, because every neighborhood may have different taxes. Like in Rockwall, we have some neighborhoods are 1.2, some neighborhoods are 2.8.
Mm-hmm.
That's a big deal. That's a difference in payments, and that can cause you, if you have a certain payment that you're striving for, that same price home in another neighborhood has a higher tax rate, may not be in your realm of being able to buy.
I was at a showing this week. It's my listing, and I was there to assist the agent coming. Her clients were from New Jersey, and those people were completely flabbergasted or scared about Texas property taxes. They've heard, like, what, we don't really understand the whole property tax situation, because property taxes in Texas is going to be different and unique, and it's state by state kind of thing. And so I was able to give them a property tax guide for all of the communities around the DFW.
Yeah.
And so it's amazing, that guide is like 3 pages, and it's every single tiny little community has a different rate. And when you start considering rural communities having MUDs and PIDs, which is municipal utility district, or public, jog my memory, infrastructure district.
Yeah. I always get, I choose the acronym.
Okay.
It's like,
well,
people ask, and I'm like, a lot of times I'll go.
At the end of the day, both of those are additional property taxes to offset infrastructure to provide you power, water, streets to your community, opposed to it just being blanketed by a particular city.
And so a lot of times when you get asked that question about, hey, we have higher taxes, but a lot of those people that are moving here also pay state income tax, whereas we don't pay state income tax here. So you're paying it one way or another.
Left pocket, right pocket, like, you can call it what you will, like, taxes are certain and it's part of the process. But if somebody's buying in Texas, they have to understand that their income's going to go up because they're not getting taxed with that income tax, but they're going to pay it from being a homeowner. And if it's not them being a homeowner, whoever their landlord is, they're going to be paying those property taxes, and by default, like, you're going to be paying into the community like that. Okay, we ran through some of these mortgage mistakes that somebody can make prior to, leading up to closing on their home. But I wanted kind of maybe a story or a confession. The question is, without identifying anyone, what's the wildest thing you've seen a borrower purchase or do immediately before closing?
Couple things. I mean, furniture, washer and dryers are always one. Cars. Sometimes I get that people, they call me and they say, hey, I'm thinking about getting divorced. And it's like, you're
in the middle of buying a home.
In the middle of buying a house. What does that look like? So that's always kind of an awkward conversation to have.
Sure.
So, but I would say, just your normal things, like, just don't go out and buy anything when you're looking to buy a house on credit.
Good advice.
Or the sad part is, I've had people that are in the middle of buying a house and a spouse passes away.
Yeah, that's tough.
I've had that happen before too.
That's tough. Well, my I guess my takeaway from all of that is if you've already begun that process and you're going to have any major life changes or you're going to do anything that affects your credit, call your lender first to make sure that whatever impact that's going to bring, that people are still going to be able to proceed with their goal and moving forward with whatever loan they've got, right?
You deal with estate people all the time with your other business. What have you seen so far?
Regards to
the most unique thing that's happened during a transaction.
Man, I'm gonna have to chew on. Oh, I've got a good one. I'm trying to figure out ones that are vanilla, not too saucy. I think one of my most frustrating transactions is I had a guy. He was working on behalf of his mother-in-law, and the guy was a very, very savvy businessman. And so he just, to a certain extent, like sometimes people think they can outsmart the market or the process. And it's like that can be a frustrating thing when people think they know better or when people negotiate for the sake of negotiating. And so this was an investment property, and so I told this guy, like, your property is worth $120,000. Like, in this market for this house, I can get you $120 guaranteed no matter what. Well, we went private market, like did a private marketing of that property, and I got him that offer, $120,000. Well, he didn't believe it, so we had to go to the MLS. No big deal. We're going to go market it publicly. We're going to try to get more. Well, we got it on MLS, and we got offers of 110, 115, 120. Well, every single time we got an offer, he would want to negotiate above the 120 offer, and he'd have to get 125. Or if he got a 125 offer, he'd want to get 130. And so some of these people were coming and going and like I put my best foot forward and no thank you. Well, every single time we negotiated for the extra $5,000, we'd get through the option period and it'd fall through. And so basically it was 6 times we had to go under contract to just land back at the original 120 that I told the guy, 2 months earlier. And it's like, hey, like if you need to see it to believe it, I'm all about it. I'm gonna keep working and pushing hard. Like, I want to serve your interest, and I want you to have confidence that like what I tell you, like I can go out and I can prove it. And sometimes you have to do that, going to the MLS and going under contract a bunch of times.
Yeah.
So
and that's why it's important right now to listen to your agent that understands and knows the market, because I talk to some of my agents and it's like, hey, we need to list this house at $799, and it's like, okay, it's been listed with another agent, hadn't sold, and we need a fresh start. And that new agent comes in and tells them, hey, here's where the market is, here's where your house will sell. And then as they're leaving the listing, it's like, hey, let's list the house at $859. And it's like, well, we can do that, but that's not where the market is. Like, you can list your house, or do you want to sell your house? So it's having that tough conversation with people is really, I would say hard on y'all's part, right?
Yeah.
But you can list a house wherever you guys want to.
Yeah.
It's just, how do you get it sold?
It happens on the buyer side too. Like, sometimes people are just shopping; they're not really buying, and it's like, I know people are buying when they're coming pre-approved, or they're having ongoing conversations with their lender, and they're taking their financial purchases serious, and all of those things. Let's talk about potential customer or a potential home buyer. If somebody wants to buy a home in the next 6 months, what do they need to start doing today?
I would say, it's time to start really having the conversation with the lender. Are they selling a house? Are they a first-time buyer? Have they ever bought before? What's the situation? Lenders today, we used to have to do hard credit pulls. And now we have the ability to do a soft pull. So I think that's one of the biggest fears that I think that people have, because credit report's only good for 120 days. And knowing that,
is my pre-approval only good for 120 days?
Once you pull a hard credit pull.
Okay.
So
I got to buy in 4 months as soon as the hard credit pull happens.
Correct. Or we got to repull credit.
Perfect.
At that point. And so having that conversation to where getting pre-approved, 6 months, your time frame 6 months, what if that perfect house comes in the market? It's like, hey, I don't want to miss out on it. And
Yeah.
so being ready versus, hey, Blane, we found the perfect house. Okay, well, now we need to go get pre-approved.
Yeah.
If there's anything on credit, if you're looking at 6 months, it typically takes 4 to 6 months for us to fix credit, stuff like that. And then also to know budgets, and then allow you to start setting them up on home searches and so forth, that they're looking in the right price point and things. And so I think 4 to 6 months is a good time frame if you're looking out, and it just gives you that opportunity. If the right opportunity falls in your lap, you can take advantage of that opportunity.
Yeah, and that's a sad thing for some of my clients when they're like casually looking and it would be nice and they have the flexibility to make a quick move, but they didn't go get pre-approved. They'll find that perfect house and it's like that perfect price in that perfect neighborhood, and by the time they go through the process, even a couple days can be a big difference, because you can go through that process and maybe that house goes under contract. You don't want that for your customers.
Yeah.
You know.
Blane, what are you seeing on your side with like listings that, market maybe taking a little bit longer than normal, 30, 60, 90, 120 days, maybe even a little bit longer?
Sure.
That people are wanting to go buy a house,
Sure.
but they need to sell their current house to buy.
Sure.
What are you doing? What kind of advice are you giving people in that situation?
My advice is always pick the right agent. No, my advice is, if you're picking an agent, you need to, one, be comfortable with them, try to get to know them, like them, trust them. That's definitely part of the process. The second thing is, when you're going to sell a house, pricing is one of the most individually most important things.
Mm-hmm.
And if you have an agent that's not comfortable with numbers or can't properly analyze what's going on in your market, if y'all aren't having conversations on closed comps and days on market, it's hard to come up with an appropriate pricing strategy.
Yeah.
What I tell my customers is, here's the market value of your home, and this is kind of a balanced approach for the value of your home. We can go about pricing however you like. My customers are in control of pricing. I just need them to know the consequence, good or bad, of what a particular pricing strategy is going to do for them. And so what I do is I say, given condition, age, closed comps in your area, days on market, like, here's what we can expect at this market price. But if we list under that market price, we can expect maybe this days on market and things speed up. And so having a contingent sale like you're talking about, maybe we're being a little more aggressive on the price instead of having a balanced price. And I've got other sellers who, maybe it's not super important for them to be out of their house now, and they really don't need to be out of their house for 8 months from now, and they want to start with more of a stretch pricing strategy, mm-hmm. where they're testing the upper ends of their market because they have special upgrades, or the house is unique, or maybe the house is just personal to them. And we can review the potential consequences of that, which is time on market. When we have those kind of conversations on market price, below market price, stretch market pricing, or anywhere in between, I always like to address the time value of money too, because you're accruing property taxes in that time. You're accruing interest payments in that time. If your house isn't paid off, you have utilities and all sorts of things. And I see a lot of people, especially seniors, that might have vacant houses or houses they've sat on for a long time. They're like, my house is paid off. And it's like, you need to slow down and really think about that. It's not just that your house is paid off and you don't have a mortgage that you're paying principal and interest on, because you're paying taxes, you're paying utilities, you're paying insurance on that property. There's a carrying cost associated with it. Well, that's just the expense side. If you take the value of that home, had they sold it a couple years ago instead of just sitting on that home, then that money could be in the bank accruing interest, or that money could be in the stock market, or that money could be, who knows, you can reinvest that money. And so they've lost money on the expense side, but they've also lost money, opportunity, interest money. Does that make sense?
Yeah. How often do you find that when you go to list a house, that somebody finds a house before they have gone under contract on their home?
That was exactly my situation on my last home sale, right? So I ended up finding a house, going under contract, had no photos, hadn't done any fresh touch-up paints, hadn't done anything, and I knew the only way with my new purchase that I was going to be able to go under contract within 60 days is that I come in at a price below market. And so I priced mine right. I did all the touch-up work, got it like market ready in 7 days, cleaned everything up, decluttered, went through the whole process. And then I priced it $20,000 below market. But I was motivated to sell at $20,000 below market because I felt like the purchase I was getting that people said yes to was $50,000 under market, right? And so let me give up 20, and that was to the advantage of the buyers. Let me give up 20, and now I'm going to go, earn 50, right? And so my net positive in that transaction was $30,000. It's a win, right?
Did anybody talk to you about bridge loan options or anything like that, so that you could potentially have gotten maybe more for your house?
Sure, and that's one of those things where I didn't even know that was a tool that was available, and so people can certainly get that loan. Like, I'm not 100% sure how it works, so that specific situation worked out perfect. But if I had gotten down to the end of that contract, there's some tools where I don't have to let that new home purchase go away. There's a financing tool. So why don't you tell everybody about that?
Yeah, so these are great buy before you sell options, considered as a bridge loan.
Okay.
And so it allows you as a seller to be able to purchase a new house without having to sell. You don't even have to qualify for 2 mortgages to be able to do it. If you do qualify for 2, then there's other options that we look at. It's not necessarily a bridge loan, it's more through a HELOC. But a bridge loan allows somebody to go buy a house with 100% financing on the new house, and using their current equity in the home as leverage towards the down payment without having to sell. Yeah, there are two mortgages, 2 closings on that, but most of the time people have found the perfect house and they don't want to lose it. And so this is where we work with our agents to strategize to make sure, hey, when you go to list your house, you're not going to try to price it high because you're not going to want to carry 2 mortgages at one time.
Sure.
So there is a cost to it, but it's a way for people to get the home that they love because that's what matters the most to them.
Yeah. So I'm sometimes a pessimist. So the first thing that comes to mind is, where can that go really wrong? Like having the 2 mortgage situation, and how do you avoid it going really wrong?
Well, it depends on each client's different. If somebody doesn't have a whole lot of cash, we'll do a bridge HELOC, so that I just closed one today actually where she didn't have the cash. Well, we did a bridge HELOC for her to be able to take the equity. She did the bridge loan, but I also left money in a HELOC to where she could make that second mortgage payment so that she wasn't feeling strapped that, hey, I only got 4 months or I only got 5 months to sell the home. We stretched it out to where she's got 12 to 15 months of mortgage payments.
Oh, that's perfect.
And she's not having that burden.
And if you can't sell a house in 12 to 15 months, you're doing something wrong, right? Well, that's great. One thing I kind of pose to some of my buyers when they're worried about mortgage rates and interest and payments and all of these things is, would you rather buy the right house with an imperfect rate, or would you rather wait for the perfect rate and potentially lose that right house? So,
let's talk about, if you wait for the rates, we don't know when that's going to happen. That house is going to be gone that you love. As interest rates come down, what's going to happen to the market?
The house prices go up.
House prices go up.
Yeah.
What also happens?
You tell me.
More people come into the market.
Oh, yeah, for sure.
So now we're competing with multiple offers.
Yep.
Whereas now, would you agree that most sellers are covering closing costs, doing buy downs, doing rate buy downs?
No, there's a lot of sellers that are offering great incentives on top of whatever your lender can provide.
Right. And so, and that's where you're, like, just on your example, you gave $20,000 less. Well, why not give, if you're going to give $20,000, give $20,000 to $25,000 towards seller concessions. They can use that towards their closing costs. They can also apply that towards a rate buy down.
Yep.
Obviously, you need to check with the lender to make sure that they're in guideline of how much closing costs you can get. But with those rate buy downs, it allows you the affordability to have an interest rate 2 to 3% lower the first 2 to 3 years. And so that gives us time and you time as a buyer to be able to have a lower mortgage payment, and as rates come down, we get to refinance you.
Yeah.
So most of the time people think, well, that's just a bunch of wasted money. Well, if you only use a portion of that rate buy down, because all that money goes into an escrow account and it's just held for the time frame. It's a 2 years or 3 years, whatever the time frame is. It's held in an escrow account and it's drawn to help subsidize that lower payment. And if rates come down, we can use any of that unused money towards the refinance. So your seller has already paid for your next refi when rates come down.
Yeah, that's super handy tool. And you got to take into consideration people's incomes grow over time too. And so when you might have that little stretch and you can structure it right on the front end, you're going to grow into something where that payment's going to be much more comfortable for you in 2 to 3 years down the road. Is it safe to say, like, these buyers can, if they're in a program like that, they can assume that financing or that restructure on that financing is guaranteed to be available to them down the road?
Well, we can't predict interest rates.
Sure.
But
like, we don't know what the rate's going to do, but if we structure it right on the front end, like, they get that kind of built in.
it gives you time.
Security. Yeah.
It gives you time.
Okay. Well, we're going to do another kind of rapid fire session, and then we're going to start wrapping things up. I'm going to ask you to complete each one of these sentences, okay? So, before applying for a mortgage, never ...
Oh, you want me to? Okay.
Yeah.
Before applying for a mortgage,
Never.
change your job.
Perfect.
Well, not never, but I'd advise before you apply for a mortgage or go under contract, talk to your lender first if you're thinking about changing jobs.
Perfect. The most understood mortgage term is?
Adjustable rate mortgages.
The biggest mistake buyers make is?
Waiting for the perfect time to buy a house.
The first document people forget is?
First document people forget. Survey.
The questions buyers should ask more often is?
Where should I start?
The easiest way to make your lender nervous is?
Man, you're asking a bunch of hard questions.
I know.
Repeat the question.
The easiest way to make your lender nervous is?
Man. Easiest make your lender nervous. I don't know that question. That's a tough one.
Okay.
Easiest thing to make your lender nervous, I would say.
Probably changing jobs or buying a car or doing anything.
Changing jobs. I would say, changing jobs or doing something, moving money around.
No big life changes, right?
Just no big life changes.
Perfect.
Man, I don't know why that was so hard for me.
Okay. PMI is not always bad because?
Because it gives you leverage. You don't have to put 20% down to buy a house.
Perfect. The complete mortgage payment includes more than?
Complete mortgage payment includes property insurance, taxes, and people forget sometimes HOA. For example, we'll talk about the HOA piece. Some HOAs can be super high. Condos, townhomes, you can see it anywhere from 300, 400, 500. I've seen it as high as 2,000, like a luxury condo in downtown Dallas.
No thanks.
So,
yeah, I've heard that the Ritz has some of those condos with some very high HOA expenses. The best time to begin preparing is? Now. As a general rule of thumb, 6 months in advance of your purchase is pretty safe too?
I think it's safe to start at about 6 months.
Okay.
Having a conversation. If you're concerned about credit, maybe sooner.
Okay. The biggest mortgage myth is?
You need 20% down to buy a house.
The smartest buyer is not necessarily the buyer with the most money. It is the buyer who ...
Capitalizes on the opportunity.
I was going to say calls William Mortgage with CrossCountry Mortgage. That's the smartest
it.
buyer, right?
That too.
Perfect. We're going to wrap things up. For anybody watching that wants to buy, refinance, or simply understand where they stand in opportunity for their next home buying venture, I want you to call or talk to or speak with or set up a consultation or do a Zoom or send an email, something with William Branch at CrossCountry Mortgage. William, will you tell them how to get a hold of you or wrap us all up? Tell us come bring it full circle, please.
Awesome. Yeah, if you're looking to buy a house, we'd love the opportunity to help you. We work with a lot of unique situations. You can reach me directly at 214-789-0477. I urge you to go online, do some research. We got over 120 5-star reviews. And my goal in this process of somebody buying a house is making it a seamless process from start to finish, that there's no hurdles, no hiccups, and we close on time, we close on budget, and everybody's happy. Communication is the biggest key to buying a house. And so we want to make sure that it's affordable for you and that you're comfortable, that when you get to closing day, you're excited and you're not nervous about buying your new house.
I invite you to have a conversation with William Branch at CrossCountry Mortgage for a no-pressure mortgage planning conversation. I'm Blane Odom with Next Chapter Realty Group, and definitely starting the mortgage conversation is an important piece in your home buying journey. Thanks for joining us today, and have a good week.